You're watching Investor Insights, and in this video I want to discuss both a strategy and the mentality of a trade or a trading method that's very effective when markets collapse. And that is investing in high dividend stocks that have been beaten down savagely, but at the same time putting aside one of our principles of always taking into consideration preservation of capital and accepting yields in its place. So the best way to illustrate this method is to give you an example. If you were to put $100,000 into a bank in a term deposit, what reason made you do it in the first place? The answer is yield. The bank may have offered a deposit rate of, for argument's sake, 5%. So you put your 100 grand in there, and after 1 year the bank's going to pay you 5 grand in interest. Sounds normal? Sounds reasonable. Now, whilst you put that 100 grand in the bank, what is one thing that you never really look at whilst your 100 grand is in the bank? And that's your capital. You know pretty much that your money is guaranteed. So your 100 grand, you never have to check on it. Your only concern is getting that 5 grand. Now, let's go back to our original discussion. Now, when you use this methodology during big market corrections, certain stocks, certain very, very large cap stocks with very high paying dividends are now even paying even bigger dividends because their prices got squashed. Now, I've always said, if you do your research correctly and your understanding of the situation allows for you to put money into a particular stock, then do it. You're not going to pick the bottom on this one. No, it's catching a falling knife. But the essence of the trade is that you have to take a stand. The example I'm going to use will be something like the banks back in 2008. I'll always use the example of ANZ because I took part in that. The stock went from the mid-20s straight to 11 odd. And it was paying $1.92 in a fully franked dividend every year. So at $11 odd, to receive almost $2, you're looking at an 18% dividend yield a year. And given that, yes, the dividend was going to be cut, and it was, you were still looking at 15 odd 14% return on your original capital in the form of a yearly dividend yield of 14-15%. This did not take any capital gains or losses into consideration. But we were happy to take a stand here because we knew that after 5, maybe 6 years, even if the stock does not move in terms of its price, we would have made all our money back via the dividend. Now, the way of thinking when you execute that trade, the mentality is such that you've put 100 grand into this transaction, and for the 100 grand you're going to be paid about 18%, so 18 grand a year in dividends. Now, earlier I said you can't pick bottoms, and we didn't, because it fell another 5 or 6 percentage points to, I think, 1070 or 1060. I can't recall, but it'll be there or thereabouts. Yes, ideally we should have bought in at 1080 or 1060, but as I said, at 11 odd, it was already paying 18% based on current recent dividend payouts, and I was happy with that. 18% is an excellent return. Now, as soon as we got in, the advice that I gave was, turn off your screens, don't look at the stock price anymore. Because number one, this bank was not going to fail. The government was always going to guarantee the banks. Number two, where on earth are you going to park your money and get 18% a year? And this was a good investment. This was an excellent trade. And thirdly, as I said with the example of the term deposit, when you put 100 grand into a bank to chase 5%, you don't have to look at your 100 grand. And we adopted the same mentality here. Don't look at your capital, only look at the yield, which was the 18%. Subsequently, the stock basically tripled in the past 5 years. And if you got in at 11, and believe it or not, the dividends have been increased over the past 5 years. So on your original $11 odd, you've basically got 100% return from dividends alone in the past 5 years. And this is one very good strategy to adopt when stock market correct in a big way. And by which I mean, I'm talking stocks get halved, stocks get quartered, stocks, there's blood on the streets everywhere. It's only effective then, and it's only effective if you know that the dividends are pretty much safe. Otherwise, you should stick to term deposits.